Hello, world. Welcome to PEPtalk, where we discuss building a regenerative economy, sustainable finance, and the stories shaping both. I'm Joe Baker.
And I'm Amira Alfa, and together we lead Planet Earth Partners.
Here are the top headlines from climate tech, impact investing, and sustainability over the last 2 weeks. Climate tech venture funding hit $26.1 billion in the first half of 2026. That's up 55% year over year, the strongest first half for the sector since 2022. In the Gulf, Abu Dhabi's Masdar reached financial close on a $6.1 billion solar and storage project. It's the single largest deal of the last 2 weeks. Geothermal drilling, Quaise Energy closed a Series B of about $134 million, led by Prelude Ventures, betting on deep drilling tech to unlock next generation geothermal. And the IPO window is open. A record half for clean tech public listings. We've got geothermal player Fervo, who are advancing nuclear development with X Energy and General Fusion, which is the first publicly traded fusion company on the market. Now we move to impact funds, where Warren Equity Partners closed its fifth fund at $2.8 billion, targeting power, water, transport, and waste infrastructure. Next up, California's teachers are all in. CalSTRS committed up to $2 billion to sustainable energy, anchoring Nuvine's second energy infrastructure credit fund. And in Paris, we've got Our Green Invest, who have raised 500 million euros for its fourth energy transition infrastructure debt fund. Moving on from impact investing to policies and standards, we've got the Science Based Targets Initiative releasing its version 2.0 of the Corporate Net Zero Standard, introducing a controversial best practices compliance framework that lets companies stay in good standing, even if they miss targets, as long as they disclose why. In Brussels, the EU adopted revised ESRS reporting standards on July 3rd, plus a lighter voluntary standard for smaller firms. And the omnibus reforms are set to cut the number of non-EU companies caught by CSRD from roughly 10,000 down to about 1,200. Stateside, the Financial Accounting Standards Board issued their first formal U.S. accounting framework for environmental credits. So offsets and renewable energy certificates finally get a rulebook. Also from Europe, effective on July 19th, large companies are now banned from destroying unsold clothes and shoes under the eco-design regulation. The EU estimates that up to 9% of textiles put on the market, as much as 594,000 tons a year, were being destroyed before ever being used. And the backdrop of it all, record-breaking heat. We had dangerous July 4th temperatures across the US, with New York and Boston hitting 100 degrees, along with record-setting global ocean temperatures. Those are the headlines. Amira, let's get right into it.
Thanks, Joe. That 55% jump is the headline everyone will run with. But I want to poke at what's underneath, because a top line number that big usually hides a more complicated story.
It does. No, it does. The growth is real, certainly, but it is concentrated. A huge share of that 26 billion is chasing power for data center demand, grid
Mhm.
infrastructure, and next gen generation. So Masdar's $6.1 billion solar and storage close is the same theme at project scale. Capital is flowing to the electrons layer.
Yeah, which is why Quaise's $134 million Series B matters more than its size suggests. When the mega deals are all late stage power infrastructure, the question for us at early stage investors is there still oxygen for frontier tech? Quaise says yes, but it's a narrower window than the headline numbers imply.
And that IPO activity is the other side of the same coin. Fervo,
Mhm.
X Energy, General Fusion going public. That's the exit environment reopening. And for anyone who's been holding climate positions through a dry spell, a functioning IPO market is what recycles capital back into that next cohort of groundbreaking technologies.
Yeah, that first publicly traded fusion company is a genuine milestone. Even if you're skeptical on timelines, it's really signaling public markets are willing to underwrite these long duration, high risk energy bets again. And that sentiment gets a shift, and it's arguably more valuable than any single raise.
Which I love to see. And I think that's a great point, right? Because fundamentally, a lot of these developments require that long-term viewpoint, right? We can't
Yeah.
be focused on short-term shareholder value or creating a solution that maybe works tomorrow but doesn't work for the next decade. We have to think
Mhm.
about systematically implementing these solutions that will not just work for decades but for centuries. So love to see public markets willing to invest in some of those long-term visions. And
Mm.
let's connect that all to the fund news, because I think there's a through line throughout it all. Warren at the 2.8 billion, CalSTR's putting up 2 billion behind Nuveen, R Green at 500 million euros. There's a clear theme with what type of capital that is.
Yeah, it's institutional and it's mostly debt and infrastructure. It's not venture equity. There's pension money, credit funds. That's telling me that the transition is maturing. It's moving from bet on the breakthrough to finance the build out. Teachers' retirement money doesn't chase moonshots. It wants contracted cash flowing assets.
Which is healthy for the sector, but changes the game for a studio like ours, right? The infrastructure layer is getting well capitalized. The gap and the opportunity is an earlier, messier opportunities that isn't quite bankable yet.
Right. And that's a nice segue to policy because policy is what turns messy and early into bankable. And start with SBTI 2.0, the best efforts framework. What's your read on that?
I mean, genuinely split on it. The charitable view is that rigid targets were pushing companies to either game the system or walk away entirely, right? They felt it was too complex, too onerous to actually report, so they just didn't engage, right? So a framework that keeps them at the table with honest disclosure is progress, right? But I know the cynical view is that best efforts is a polite word for optional, and it hands every laggard in the industry a built-in excuse not to keep up with those ever advancing standards.
Yeah, and I think we've talked about this so much, Joe. And my worry is credibility and the value of SBTI's commitment before was that it actually meant something. And if these standards soften, the burden shifts back onto investors to verify like these claims ourselves, which frankly is where diligence should have been all along. It's just got more expensive to trust a logo now.
Yeah, 100%. And it's interesting to see the EU moving in a slightly different direction, right? So with the omnibus reforms cutting CSRD's scope from 10,000 companies to 1,200 companies is a massive rollback of who has to comply, as opposed to SBTI, who's really trying to bring more people into the fold.
Yeah, that was a wild change. And
hmm
that's the tension of 2026 in just one data point. There's more standards, narrower nets. Europe is deregulating at the edges to stay competitive while not trying to gut the core.
Meanwhile, the US is quietly doing something substantive. FASB's ASU 2026-02 giving environmental credits and actual accounting standards. Much less
Yeah.
flashy, but if carbon offsets and RECs now have a consistent treatment on the balance sheet, that de-risks an entire category of climate finance.
Yeah, I mean, we don't have the SEC, but we'll take this for now. And I agree. That's the the sleeper story. These markets need rules to scale, and a credit you can't account for consistently is a credit. It's a credit institute. It's what they won't touch. These credit institutions. So this is plumbing, but plumbing is what we invest behind at the end of the day.
And I think that's where you see a lot of true movement is when you have a well-laid, defined path that organizations can all get behind. And so as we move into the last cluster of headlines, it is a mood shift, right? The EU is banning the destruction of unsold clothes, and the environment around us is reminding us why we need to.
Yeah, and this ban is really exciting for us, right? It's a circular economy policy with teeth. There's up to close to 600,000 tons of clothing that's destroyed every year. And now these large retailers have to actually resell, donate, or reuse with annual disclosures and fines for violations. And that creates one, like a real demand for reverse logistics, but also for resale and for the refurbishment businesses. It's a regulatory tailwind for an entire category of startups that we have been looking at and working with. So really excited for this to actually move that forward.
And the work that some folks in the space are doing has been really exciting to see, and we've certainly enjoyed diving deeper into this topic, which we're about to later in this episode. But as we round out the news from the last couple headlines, just important to really contextualize this right into the why of that we do the work that we talk about here on PEPtalk. And the recent heat wave is just a reminder of why any of this matters, right? 100-degree days, record ocean temperature. The physical signs keep outrunning the policy response, at least in my opinion.
Yeah, and so here's where I land for the week. The money is maturing, The exit window is open, and the policy picture is genuinely mixed. It's tighter in some places, it's looser in others. But for us, the signal is to really lean into the layers that are underserved. The early frontier tech and the mega deals skip the circular and the adaptation businesses that policy is just now creating markets for. So this is an exciting time.
It is. No, anytime there's movement, if you can in some way read the crystal ball, there's opportunity to be had. And I think the ban on destroying unsold apparel is one of those
Mhm.
really big shifts in the market. And so for that reason, we're gonna have to we're diving into both the ban on destroying unsold apparel as well as textile circularity in general. So it is wild that we needed a law to tell retailers and fashion designers to stop lighting their inventory on fire. But I'll take what I can get.
It's wild that it took a
There,
law, and I feel like I've said wild too many times today.
there's been a lot of those surprising moments where you just have to shake your head a little bit, but keep rolling with the punches. So now that there's such a significant shift in regulation, and how does that translate to the supply chain? Like, where does all of that unsold apparel go now?
Yeah, I mean, well, that's the deep dive, right? Off-price liquidation retail, is that channel genuine circularity, or is it just a pressure valve that quietly makes overproduction worse?
Fair question. I already know where I land on this one for what it's worth.
Oh, good. Let's fight about it then. Let's do the numbers first.
All right.
So there's 92 million tons of textiles discarded globally every year, projected to hit 134 million tons by 2030.
That's not a rounding error. That is an entire waste category.
Yeah, and a chunk of that never even reaches a customer. For example, I don't know if you recall when Burberry got caught burning millions of dollars of unsold stock and they framed it as brand protection. Everyone else called it what it looked like. Nike destroying unsold stock back in 2017, or H&M when they had their warehouses stacking up with excess for years now, to the point where it's just a recurring news story at this point. It's not a scandal.
Which is the part that gets me really. This isn't just three companies having a bad year. And frankly, it's not just these three companies, right? I mean, those
Right.
are three headlines that are easy to reference, but I think you could find similar headlines about much of the good work they're doing in this space. And you could find three headlines about three entirely different companies who have similarly destroyed inventory or not put in the investment into building a circular supply chain. But it is a decade of the same pattern, right? And it is from some of the biggest names in the industry.
Yeah, and it's not irrational. If you actually think about it from their side, if a luxury brand dumps unsold inventory into an outlet at a steep discount, that tells the market that the product was never actually scarce. And that's a real hit to the full price business.
Well, that is about pulling the curtain back on luxury retail in general. There is also always like a false sense of scarcity, whether it's diamonds, whether it's fashion names, right? In some ways,
Hmm.
it's a theater that we all as consumers buy into and participate in, right? But at the same time, just because it's rational for them, it's not fine. It's not the systems that we need to establish, right, to have a truly regenerative economy, right? So it just depends on what criteria you're applying to it, right? If it's the profits for next quarter, if it's short-term shareholder value, yeah, it's rational. But is it fine if you're thinking about building systems and economies that will be conducive to protecting the environment and regenerating some of the damage we've done? Right. I think those are two very different questions. And frankly, I think the second trumps the first question, but
Hmm.
plenty of rational corporate.
Oh, yeah, definitely not arguing that. Just saying that's why destruction and warehousing became that safe choice for so long instead of discounting, which is exactly the choice this new EU rule just took off the table, which is excellent.
Good first start, right? No more torching
Yeah.
it, but now it has to go somewhere.
Yeah, exactly. So resell, donate, recycle. And that's the moment where off-price retail stops being a nice to have and it starts being required infrastructure. So let me make the strongest case for it. And you tell me where you actually disagree, because I don't think you're going to just nod along here.
We'll see.
So, one industry analysis from this year put it plainly. They said off price is no longer a temporary release valve, it is a permanent part of the apparel ecosystem. And that's a real shift. This isn't a stopgap anymore, it is actual infrastructure.
All right, no, fair point.
Yeah. And the volumes, the volumes that we're seeing back it up. The US secondhand apparel, if we want to call it an industry, was over 56 billion in 2025. Global resale passed 210 billion, and a huge amount of that is being fed by returns, whether it's online apparel return rates, which are running 20 to 25 to 35%. And without a liquidation and resale channel absorbing all that, where does it
A
go?
landfill most likely, or a warehouse until the warehouse is full. And that's actually one of those experiences that was really eye-opening to me through some of our work with folks in the space, Global being one of the startups we're actually going to talk about later in the conversation. But just glancing at the warehouse, it was rows and rows, 40 feet high, boxes as far as the eye could see, and tens of thousands of garments coming in the day and coming in a day. And frankly, they're a small part of a much larger ecosystem, right? So that is just one node in a interconnected web of uh, clothing, resale, refurbishment. And so those numbers are just a small slice of a much larger pie.
Yeah, that's right. And with every garment that goes through liquidation instead of a shredder is one that displaces a new purchase and stays in use longer. And that's circularity in the most literal sense there is.
I don't actually disagree with any of that.
But I can hear a but coming.
You're intuitive. So here's my but, right? If a brand knows that there's always a buyer for their overproduction, even at a loss, why would they really fix their forecasting and their inherent overproduction, right? You've just made
Mhm.
producing clothes cheaper, knowing that there's a secondary market for any of that don't get sold on the primary market, right? That's not a side effect. The entire incentive structure is working exactly as badly as you'd expect when you have that pressure release.
Yeah, that's the moral hazard argument. And I think it's fair. I don't think it's the whole story, though.
All right. Well, I mean, what would be the other half of that story?
I think there's that separate lever moving right now that's actually attacking the root cause, which is AI driven demand forecasting that can project trend demand up to 2 years out. Tighter assortment planning, that's not cleanup, that's prevention. Different tool, different part of the problem.
Sure, but I mean, a forecasting tool existing doesn't mean that brands are under real pressure to use them. And if the failure of overproducing still has a soft landing, they may not be incentivized to really change their behavior.
Yeah, I agree. But I'd push back a little. The ban itself does add pressure. It closes off the cheapest failure mode, which is destruction, and it leaves liquidation as basically the only legal ramp off. That's not nothing.
It's something. Yeah, no, I mean, I just don't think it's circularity solving the problem, right? It's like circularity managing the symptom. It's a band-aid solution. Well, the actual
Hmm.
disease, chronic overproduction and overconsumption, keeps humming along underneath it, mostly unbothered.
Yeah. So then where do we land?
Well, both things can be true, right? And I don't think they cancel out as neatly as it's complicated. Off-price
Hmm.
retail is real. It's a useful
Hmm.
solution and valuable circularity for the inventory that already exists, right? But it's also quietly propping up the exact behavior that creates the inventory in the first place, right? I don't think you get to feel great about both halves at once.
Yeah, that's fair. I'll take that as our actual answer instead of a tidier one.
I'd usually prefer a messy answer as opposed to a tidy one
Yes.
that feels nice but doesn't actually get to the root of the problem. But when you think about where the rubber meets the road, right? How does this turn into an actual due diligence question? Because that's oftentimes where these discussions are headed.
Yeah. How should an LP evaluate a secondary market or a liquidation business? Genuine circularity play or a discount retailer riding a regulatory tailwind that might not last?
If I had to guess, your answer isn't check if the tailwind is durable or not.
Yeah, it's actually the opposite. Assume the tailwind isn't the point. The underlying volume was already growing before this ban existed. These 92 million tons a year, heading to 134 million. The ban just closes off one exit ramp. Even if the regulation got watered down somewhere else tomorrow, case in point, CSRD, that volume doesn't evaporate.
So, what should you be looking at if you can't assume that this regulation is permanent?
That's a great question. I think something to think about is, does the company have durable sourcing relationships with brands and manufacturers that exist independent of any one law? A liquidation business with long term supply agreements is a fundamentally different bet than one that just opportunistically buys whatever surplus shows up because the destruction briefly became illegal somewhere.
The regulation's a tailwind, right? But you really don't want to use it as your entire thesis.
Yeah, exactly that.
Well, although it's not a thesis in and of itself, it is a forcing function, right? And so today we're going to dive deeper on textile circularity and spotlighting two companies actually attacking that same 92 million ton problem from opposite ends of the spectrum.
Right. And I really love this pairing because they barely look like they're in the same industry. One is deep tech biology and the other is retail logistics, but both answer that same question. What do we do with clothing the system would otherwise throw away? What happens in that next chapter?
And so we start
And
with MycoRenew, which is a Polish biotech company, and the pitch is almost sci-fi. They use a consortia of filamentous, a hard word for folks who may not be in the space, fungi to break down textile in weeks instead of centuries, and not just the easy stuff, right? Cotton and wool decompose on their own anyway. The hard problem is synthetics, right? Polyester can sit in landfills for centuries, shedding microplastics, toxic dyes, but MycoRenew says their fungi can degrade even polyester.
yeah, the proof point that stood out to me with MicroRenew was they've hit their technology readiness level 4. So they built and validated their first bioreactor in their t-shirt pilot. Mayors from 6 Polish cities have handed over real polyester sportswear, and the science team identified fungi that could actually break it down. Their words is genuine R&D, not PR.
And I like the model they're using as well, right? Recycling as a service, sold to cities, manufacturers, landfills, right? Not the consumers themselves. So the byproducts don't just vanish either. They get turned into eco bricks for construction and eco leather for fashion. So that is really using or building that circularity where the underlying building blocks can go back into new products. And they're chaining together a fungi wardrobe relay of cities, as they put it, across Europe right now, 6 so far, aiming for over 100.
Yeah, and it's a fair caveat. This is early. TRL4 means validated in the lab, not scaled in the market. But the timing is right. With the EU now mandating separate textile collection and it's is standing up extended producer responsibility systems, someone has to process what gets collected.
I love to see the progress they're making and the adoption they're getting from a lot of those cities. It's exciting to really see some of those breakthroughs come to fruition. But now if you flip to the other end of the problem, right? We've talked a little bit about Global, reverse logistics company with a retail operation called Ministry of Brands, which is an off-price retailer out of Colombo, Sri Lanka. And those two businesses are intrinsically linked, right? Global is the reverse logistics engine behind that broader and forward-facing retail footprint.
Yeah, and here's the circularity angle that's easy to miss behind the discount pricing. Their line is that value shouldn't disappear after one season. They take brand new surplus and end of season inventory from over 2,000 international brands, the stuff that would otherwise be liquidated or destroyed, and get it back onto bodies through authorized off price resale.
So the reverse logistics piece is the engine, the sourcing, the sorting,
Mhm.
repairing, and rerouting unsold branded stock into a market where it actually sells. It's keeping perfectly good clothing in use instead of ending up in a landfill.
Yes, exactly, which notably is exactly the behavior the EU ban is trying to force. They're just one step ahead, which is really great to see. Retailers can no longer just destroy unsold goods, they have to resell, donate, or reuse. And a resale channel in secondary markets is the commercial answer to that mandate. So here's the head to head. And I think the key is the waste hierarchy. At the top, keep things in use, resale, reuse, repair. And at the bottom, above only landfill and incineration, is recycling and material recovery.
Global in the Ministry of Brands lives at the top, right? Garments stay garments. They are used for their primary purpose. It just finds a secondary buyer. Highest value retained, lowest energy, and it's a working business model today with stores on the ground.
Yeah, and then there's micro renew, which lives at the bottom, but that's a feature, not a bug. It's built for clothing that genuinely cannot be resold, whether it's stained and can't be removed by the global team, as an example, or torn, blended synthetics no one will buy. So instead of going to the landfill, the fungi returns it to the raw building blocks. It's earlier and more capital intensive, but it solves the part of the problem that resale can't touch.
And at the end of the day, they end up being wonderfully complementary instead of competing, right? Resale skims off everything still wearable. Fungal breakdown catches what's left. And the failure mode today is that middle, the collection and the sorting of overproduction. And that's in some ways what's missing. So wearable clothes are still getting destroyed and unwearable ones are still getting in the landfill.
Yeah, and for us, that's the whole thesis in one frame. The EU just created the demand, mandatory collection, no more destruction, and the winners will be whoever builds the infrastructure between the bin and the next use. Resale channels like Ministry of Brands at the top, and material recovery like Micro Renew at the bottom.
Two companies, two ends of the same problem. Keep it in use as long as you can, and when you truly can't anymore, don't bury it, transform it.
I couldn't have said it better. And that's our deep dive on textile circularity today, summarized.
Thanks for joining us for this week's episode of PEPtalk. As always, please reach out if you're interested in collaborating with Planet Earth partners. Always a pleasure, Amira. Thanks so much.
Thanks, Joe. See you guys next time.